Earlier this week, I posted a video about the RSI divergence strategy, a popular technique for spotting potential trend reversals. But I didn't want to stop at just the theory. I wanted to see how it performs in real world trading scenarios. After all of us are just learning, and I did this just for the purpose of learning. Or perhaps it was because I was so focused on RSI divergence lately that I started spotting this pattern everywhere. Either way, I decided to put it to the test with a stock that I have been following for some time. This is the ICICI Bank, which is a major regional bank in India. The ticker symbol is IBN. So without wasting any time, let's have a look at how I tried to apply this. As you can see, this stock was on a strong upward trend during the November to December period. Many traders might look at this kind of a price action and think it's a sign of persistent growth, jumping in with the expectation that the momentum will continue. But as Benjamin Graham famously said, and I am a big fan of him, the return on a stock depends just as much on the buying price as they do on the selling price. So I always try to practice patience before entering a position. Even if the stock falls further, this approach helps me ensure I'm not sitting on a major loss. So now fast forward to January and the stock has taken a turn. It's been in a clear downward trend, forming lower lows and lower highs, a classic bear formation. At this point, I decided to see if the stock was showing any signs of RSI divergence. Well, divergence can be really helpful for identifying when a trend might be losing momentum and perhaps it's preparing for a reversal. So let me quickly add the RSI indicator to this chart. Just as I suspected, while the RSI lows were initially in sync with the price action, the last 2 points revealed a divergence. Well, what does this mean? While the price continued to make lower lows, the RSI made higher lows, signaling that bearish momentum might be weakening. Ideally, I would want this to be a slightly bullish formation on the RSI itself, but in this case, we see a flat line on RSI. This gave me the confidence to consider opening a position. Well, while we should look at other signs as well, but I had been tracking this stock on a number of indicators already, so I was aware of how it's moving. So based on the divergence, I personally decided to open a small position at this point with the intention to averaging up if the stock formed another lower low, which gave me a sign of double divergence. This approach allows me to maintain flexibility while mitigating risk. However, at the moment, and perhaps unfortunately for me, the stock has now breached a key level which suggests it could be preparing for a potential reversal already. While that's disappointing for me, it's also an important reminder that even the strategies like RSI divergence, the market doesn't always follow the expectation. Well, this example just highlights both the power and the limitation of using RSI divergence in our trading. It's a great tool for spotting potential reversals, to be honest, but it's not a guarantee, and that's why it's essential to pair it up with proper risk management and a clear plan. And whenever you're applying this, try to practice this in more and more stocks to get more experience on how this actually applies. So if you found this analysis helpful, let me know your comments, and in future I plan to do a bit more of these. So if you found this helpful, don't forget to subscribe for more videos like this one and leave a comment or a question in the comment section so I can improve my future videos so that we can all learn together.